Good evening, everyone. Let me quickly do a very fast sound check. And okay. So, good welcome to another session with FSMOne's webinar. And today's topic, right, I think everybody would have been attracted with the topic itself, the one investment that everyone should have. So my name is Bhushan. If you can hear me clearly, yes, I can. You can actually use the chat function to actually interact with me along the way. I am an investment counselor with IFAS and also FSMOne. So, um, this is how we will be setting up today's session, right? The next 45 minutes or so. We will run through the topic for today, and then I'll have Q&A sessions in the last 15 minutes. And along the way, feel free to just like ask your questions, put your questions in the chat, and I'll be actually answering you. Okay, so with that, let's get started. Let's get rolling today. And thank you again for joining us today. Um, on another round of FSMOne's webinar, where we actually aim to help our clients to invest globally and profitably. So, a first quick question is that if you have never guessed it, maybe you have guessed it from the topic itself. It this just to break the surprise, right? The one thing is actually an ETF. Okay, so before I start, right, I'd just like to know from the audiences here, how many of you have already invested in ETF? If you have, you can just put why. If you have not, then you can put no, N for no. So I can have a gauge why. All right, cool. Wow. So a lot of no's, some ands. Yes, yes, yes. Okay, so we have a lot of no's, a lot of some, and so that's actually a balanced crowd. Okay, that's nice, that's nice. So my objective here at the end of today's session is that if you're already doing ETF, RSP, and how do you actually continue doing your ETFs? Those who do not have not done, I think this could actually inspire you to get started. And let's get into the topic. So as usual, we have a quick disclaimer. Today is a sharing session. It's not a buy or sell call. And first thing first, right? Let's just put aside all about ETFs and the tools that we have, right? On our platform, we have many tools on for investments. Why do we actually invest in the first place? Correct? That's the very main question, right? Why bother investing? Okay. So a very simple thing to get everyone started here is that as a working adult as a Malaysian, every one of us, according to KWSP's data, shows that need to be a millionaire. Let me repeat that again. All of us need to be a millionaire to retire comfortably in Malaysia. So being a millionaire is no longer an option, it's actually a necessity, right? Because that is what the number shows. It's that uh, in order to sustain our retirement life, that is the pool of money that we need. But sadly, as you can see, and would have seen these news headlines being reported by EPF year after year, it's that only 18% to have like 1,000 a month for 20 years post retirement, and that is not even to cover the basic necessities. So how do we then go about it? Okay, so the usual way, typical Malaysians, that we build our nest of egg is that definitely if you're working adult, KWSP, if you're having your own businesses, you can actually self contribute. And of course, this is our favorite Malaysian way of investing. It's like through properties. And lastly, it's that through investments. Okay, these are the general ideas that we get, right? So EPF is given property. That is a topic for another day. Focus for today's it's on investments. When we talk about investments, right, why does this matter, right? So if you look at this particular graph, this bar chart, a lot of colors here, but let me help you to walk you through this particular graph, right? How do you look at it? If you look at, maybe I could actually pull this laser. Yeah, perfect. So if you look at here, middle income, upper income, ultra rich, and what do you notice? It's that this is based on data from the US, where do most of their wealth, the net worth, is actually derived from? If you look at the middle income, it's mostly the principal residence, means that the house that you're currently staying in, pension account, this you can actually equate to the KWSP EPF. But in order to actually grow the wealth, how do you do it? Majority, it's that you can see here, this green chart over here shows it's from Oops. It's from actually stocks and securities and businesses. So you either start your own business and be successful in growing that business, or you invest in the securities market in stocks and securities. And one thing to note here, it's that very important. It's that when you do this, what you're actually essentially doing is that when you invest in the markets, when you buy a stock, what you're doing is that you're actually being a part owner, a co-owner of a business, right? For example, if you buy the stock of Maybank, you're actually a co-owner of Maybank. Albeit if you just buy a small fraction of it, you're still maybe you just own the doorknob of one particular Maybank branch, right? Still you're an owner. Okay, so this is to show that by by investing, especially through the stock markets, is actually a very valid way to grow your wealth. The next question is then, what is stopping us from investing? Because I think whatever that I just said in the past, let's say 5 minutes, right? You already know this, right? You know that you need to do this. But what is then that stopping us from doing this? It's most likely any of one of these reasons, right? Either you are limited by capital to grow, you struggle to save and invest every month. Actually, you don't have the time to do the research, and also you're confused by what's happening in the markets. Okay, and that those are actually very, very, very valid reasons to actually have. But then, right, when you are confused, the very last part, right? So what do you do next? Is that normally the first thing, usually what we do previously is that Google to get answers, right? But nowadays we have AI. So we ask AI or ChatGPT or Gemini or Claude, like, tell me what stocks to buy now. Okay, and then it gives you this list of stocks, right? If you actually run that same questions on Google, on actually even on YouTube, on TikTok, on Insta, you are actually day by day bombarded with so many information that's coming to you that you should buy this stock and buy that stock, correct? But play with me, play along with me. Like, do you resonate with this, that whenever that you actually look at these people actually saying that, hey, you should buy the stocks, and you were convinced with your argument, and you go and buy that stocks, what happens next? Most probably, the time that when after you have bought it, the stock could actually drop down all the way. It's like you'll be like, why is it that how come they are making money, and how come is that when I bought the stock that then the stock price suddenly drop one? Like, am I so unlucky, right? Have you like went through that? If you're just going to do this based on uh the tips that you actually get it from online and whatnot, and if you have actually experienced this, just to assure you, right, you are not alone. Okay, because statistically, if you look at this chart, this histogram over here, right? Majority of the people. So when I say majority, it's almost 80% of the people actually lose real money in the stock markets in the long run. Right. So this is actually data that is sourced from trading a brokerage platform. And there's also, yeah, on the tail, yeah, you have these outliers who do actually make money, but they're actually outliers. Okay. Because the reality is that uh, this is actually the 20 years annualized return by asset class that is actually compiled by JP Morgan up to 2021. And you see that there are so many different asset classes here. So this is the market return. So S&P 500 is the benchmark index that actually measures the return of the US market, right? But this is the return of the average investor. Okay. And the reason is that you might actually went through this yourself. You have actually felt this yourself. Uh, so could this then be a better way to invest or get exposure to the markets? So number one, we know that in order to grow our wealth, besides the KWSP EPF that we have or the properties, we need to invest. But the thing is that the question is that how do we then invest? Because looks like everything, the odds are actually against us. So what if I tell you that you can actually invest without looking at the headlines news every single day, without deeply analyzing at financial reports of a company. Because remember, I said that when you buy a stock, you are actually a co-owner of a company. So it is actually your duty and responsibility to look at the numbers of the companies, to analyze the companies, to know that how well the company is doing. So you don't have to do this. And lastly, it's that you don't have to look at technical charts. You would have seen like some fancy candlestick charts and different type of indicators that looks pretty cool on the monitors, but sometimes it could actually make it worse for you. And is there a way? There is. So this is actually the MSCI ACWI. You see the title over here, right? So what does this means is that this is actually an index that tracks the global stocks. That means the stocks that's listed predominantly in the developed market globally and weighted, and then it tracks the movement of those each individual stocks that's on the index. So as you can just see, I didn't actually take a very long history, started from 2017 up to year to date, right? This is up to last week. And you can see that the markets have been actually experienced a lot of ups and downs. And this is actually in ringgit terms, right? So the numbers, the graph movement that you see here, right, is actually converted from ringgit. It's not in US dollars. So even so earlier that we had the first Trump administration, the first trade war, and then there was the COVID pandemic, and there was the lockdown, and then there was the crackdown, lockdown, and then the market actually rallied after that all the way due to AI. If you remember, this is was when was that ChatGPT was first introduced, and all the way, and then Trump was elected again, and then there was the so-called Liberation Day, the tariffs, right? And then most recently, it's the US-Iran war. But after all this so-called major events and devastating event that happened in the world, right? What do you see actually in the longer term, right? What do you see? The market is actually going in a uptrends. And if you look at it, right, what it's this most recent results, then you can see that in 1 year, it's 19.1%. This is in ringgit, and 3-year annualized. So what it means by 3-year annualized is that by 14%, it means it's not that total 3 years is 14%. It's every single year on average is 14%. So do you think that this is a pretty good return? Like if you want to gauge it, you compare I mean, you can't compare that it's not an apple to apple with FD, but maybe to EPF returns, typical investments that you have, the returns, and the returns that just by tracking, following, investing into the global markets, pretty good, right? And so this is what I'll say that why not then get invested into the global markets itself and by just tracking and by just investing into the global markets. And what it means technically, when remember at the end of the day, we're buying stocks, right? You are essentially owning all the top companies in the world. And you are not limited to just US based company, but predominantly you can see that there are US companies over here, Apple, Google, Nvidia, Amazon, Tesla, Microsoft. Not only that, but also you have your Samsung, Korean company, TSMC, Taiwan listed, Tencent, it's listed on the Hong Kong Exchange. And you can own all these companies with just one ETF. And what is that one ETF that you can consider? It's the Vanguard FTSE All World UCITS ETF, or in short, the VWRE. So this is how you actually gain exposure to global companies with just one instrument. It's by investing in this one particular ETF. Okay, so just bear with me. Those who have not, this is for those who have not invested in ETF. I'll just do a quick run. Those who have invested, you know about ETFs. Just bear with me. Maybe you might learn something new also. So what is ETF is that it stands for Exchange Traded Funds, right? It's just an ETF is an acronym for these three letters: Exchange Traded Funds. So what it means by Exchange Traded Funds is that first, when we say exchange, it is listed on an exchange, right? And then traded means it is traded. That means you can actually buy and sell like a stock. And when it funds, it means it's a basket of stocks. It could be stocks, it could be any other instruments, but for today's discussion, let's just say it's basket of stocks. So that when people usually ask me, right, hey, do you have this ETF? Does FSM has this ETF? So I'll frame that question in a better way. I'll say that, is this ETF listed on the London Stock Exchange, or is this ETF listed on the US or New York Stock Exchange, Nasdaq or Hong Kong or Bursa? Because it is not whether that FSM has it or not, it's whether that particular ETF is listed on the exchange that we carry or not. So that is the question that you need to ask, right? So ETFs ETFs are actually listed on an exchange. They behave like a stock that you can buy and sell, and they actually are a basket of funds. So to put it in illustration, to illustrate better, right? I think a lot of people, if a lot of you, if you follow us, we used to be known as Fund Supermart, right? This means that we do carry a lot of funds. There are platforms for funds or mutual funds or unit trust funds. Essentially, that is how an ETF is structured. Means is that it is structured like a fund, unit trust fund, but the difference is that it's traded on a stock exchange. So means is that you can actually have live price when the market is open. Okay. And most of the ETFs, what do they do? It's that they actually track an index. So when I say track an index, what does it mean by track an index? Okay. So to give you an example, this is the S&P 500 index. So you might have heard this word, right? S&P 500. People are mentioning, you would have seen in the news that S&P 500 like went up by how many percent today, went down by how many percent today, and so what does actually it means by S&P 500, right? So S&P 500 essentially means that the top 500 companies by market cap that's listed in the US, right? So in the US, there are few exchanges of all this of those companies that's listed in the US market. Who are the top, what are the top 500 companies, and by market cap weighted, these are the companies that is constituent of the S&P 500 index. Okay, so the thing is that you can't actually buy an index, because index is just a way that something is being measured. Okay, because we measure the US market, the how well is the market is doing by tracking the top 500 companies by market cap in the US market. If you want to buy the index, then you need an instrument that is called an ETF. So here, Vanguard 500 Index Fund ETF, or the ticker symbol of VOO, is the ETF that tracks the price movement of the S&P 500 index. Okay, so just to give you an overview, right? And to put it in perspective, I mean, to give you more examples, is that so these are the ETF that's they are these are the examples of ETFs, and their ticker symbol means is that any instrument that is listed on a stock market, they would have a ticker symbol, and this is the index that is tracking that. What is the index that is being tracked, and where is it listed on? So example, VOO. What does it do? It tracks the S&P 500. It's listed on the New York Exchange. QQQ. It tracks the Nasdaq 100 index. It's listed on Nasdaq. Earlier, I introduced you to VWRA. It tracks the FTSE All World Index. It's listed on the London Exchange. Even in our home here in Bursa, there is the FTSE Bursa KLCI ETF. What it does, it tracks the KLCI index and so forth and so on. So there are also very specific index like Sharia-based index. And then there's an ETF that tracks the Sharia index that's listed in the US. Okay, so why is that we use ETFs? Is that because it's most of the ETFs are actually passively managed, means that they just simply track an index. Means because they track an index, right, it's low cost. So meaning that there is no active fund manager who's actually buying and selling based on their research analysis. They simply just track an index. So for example, if NVIDIA goes up by 3% today, and then NVIDIA, it's for example, maybe 9% of my weightage, I just look at that percentage, that weightage, and then how much it moved. I just adjust it and track it accordingly. And because it's just passively tracking, you basically nowadays you don't need human for it. Like machines can do that. And that's why it is such a low cost instrument, because there's no active analysis or research that is being done to find the value of the company. It's just following what the market is doing. And also, since it's listed on a stock exchange and you have live price when the market is open, it's actually very highly transparent. You can actually anytime go to the holdings and see that what is today's holdings of your or VWRA. Okay. And at the same time, right, we as investors, when we buy into ETFs, some of the things that we need to know is that these are the four things that you need to know, which is the expense ratio, the brokerage fee, tax, and of course, most of this in global ETFs, right? If you're buying ETFs that's not listed in Malaysia, you are subjected to FX rates. One thing that I like to focus on here, this especially on this part, it's that on the tax itself. So why this is important is that because if you buy an ETF that's listed on in the US, and when that ETF actually declares a dividend, as a non-US residents like us Malaysians, we will be taxed 30% on the dividend. It means when the dividends comes in declared, you will only get 70% of the dividends, 30% is being withheld. Okay, so this is an important. So because of this, what an option, a better option if you're actually investing for the longer term, is actually to consider the London Stock Exchange, because instead of the usual 30% withholding tax on the dividends for a US on a ETF or stock that's listed on the US exchange, you are actually subjected to only 15% of tax. It is much lower. And at the same time, what is interesting about the London listed ETFs is that you have this one particular thing called accumulating class. So what is then an accumulating class? So when we talk about accumulating class or distributor, then we must first talk about distributing ETFs. Okay. So as the word suggests, right, distributing, what does mean? It means you're distributing. So it means that you're giving out, correct? So that means when the ETF actually declares a dividend, the dividend are automatically distributed, right? So when they're distributed, you actually get it in your cash account. Here, the point to take note here is that all US domicile ETFs are actually distributing ETF. Means is that by default, when the ETF actually declares dividend, that dividend is actually distributed to your cash account. Remember, minus the 30% withholding tax. So when you get it, it's 70%. Okay. But if you actually go for the accumulating ETFs, means is that is listed on the London Stock Exchange, then you have the option to opt for an accumulating ETF. So what does an accumulating ETF means is that that dividend that is declared, right, it is not distributed into your cash account. That means you don't see it in cash. It is automatically reinvested at no extra expenses. Okay, so imagine this like this, right? You're investing for the longer term. Okay, if you invest in the US market and then you get the dividends, first thing is that it is 30% withholding, you only get 70%. So then with the dividend that you get, right, then you need to actually manually reinvest it yourself, and that is actually another extra cost for you, because there will be a brokerage cost when you actually buy into a new units, correct? But if you're going for an accumulating class, this is done automatically. This is done without no additional costs, and this will actually help to accelerate the compounding impact of investing in ETFs. And you can actually see just side by side examples over here, right? Same ETF that tracks the same thing. Remember, what is an ETF? It tracks an index. So this is on NYSE in the US. It tracks the S&P 500. This is VUAA. This is listed in the London. So you can see that LSE, right? They do the same thing, means that they track the S&P 500. So one is an distributing, one is an accumulating. So dividends are automatically reinvested for the accumulating class. And here you can see that you no need to do a manual reinvestment, and it supports your long-term compounding display. So then the next question is that, hey, why do I actually need to do this? Why do I actually need to reinvest my dividends? Why can't I just enjoy my dividends? Very valid questions. But here, remember that if you're actually investing for the longer term, right, for that means for the next 5, 10, 15 years, right, what will be more prudent will be actually to reinvest those dividends because it will help out in your compounding. And to illustrate this, right, historic, if you just stretch on history, you can see that back again, remember, this is the same index that we saw, the MSCI All Country World Index. You can see that majority when with time, right, with time, with majority of the returns of the investments, it's actually with dividends that's being reinvested, right? More than 50% of the market returns, the total return, are generated with reinvested dividends. So if those dividends are actually cashed out, yeah, of course, you can manually do it. That's just more work, or you can actually spend it or do something else with it. But just leaving it inside and just reinvesting it actually would bode well for investors in the longer term, right? Based on what we see in the past data. Okay, so with that, we are 30 minutes into today's presentation, and the last 15 minutes, I'd just like to spend a little bit of time to actually get into our main topic for today. It's that the one investment that everybody should have. Okay, so and I've already introduced you to you that actually what that one investment is. It's just buying into the global markets, the VWRA ETF. So in the next couple of minutes, is that I'll just like to build my thesis, my case to you why this is so. Okay. So number one, it's that why global ETFs. So they are actually, you can tell me that, well, now I can actually buy ETFs to speculate on the price of oil, for example, right? Oil price after the so-called ceasefire talks and non-ceasefire and all these confusing headlines, price has been going up, right? So I can maybe speculate on this. Maybe I can do some like 2x, 3x leverage. Maybe I can short the markets. But call your horses first. Before you do any of this, right? I Everybody, in my opinion, it's that should have a very basic global ETF. Why is so? If you look at here, by having a global ETF, automatically you have exposure to all the top companies in the world, right? So here it is actually divided by different sectors. The colors are actually in different sectors. So you have like in this, what do you call this, teal color? Yeah, technology sector, consumer discretionary in guava pink, the blue, purple, right? And most likely that you would actually recognize most of these brands, they're actually global brands. And just by having exposure to a global ETF, you are getting exposure to the top companies in the world. And why is this the case, right? And this is something interesting, a study that was actually being done by the state Arizona State University by a professor called Professor Hendrick. What he found out is that the majority of the stock market wealth is only generated by a tiny fraction of high performing companies, right? So what he did is that he analyzed the stock data from 1926. So that is actually a pretty comprehensive data to actually study on. And he only found that around 4% of stocks, only four, let me repeat that again, right? Only 4% of stocks were responsible for the net wealth creation in the US. That means most individual stocks actually underperform even something like government bonds, right? And historically, half of the market gains were just coming from 90 companies. Companies like your usual suspects like Apple, Microsoft, Amazon. And and at the same time, you can see here is that of these 90 companies, just 30 stocks account for the full wanted cumulative wealth generated in the US market. So what it means is that, remember the earlier chart, very first chart I saw that almost 80% who trade the market, they actually lose money. Only certain people who knows how to really master the art of trading, they make money. On top of that, even if you do your fundamental analysis, you look at the companies and you actually invest in those companies, right? Undervalued companies can stay undervalued for a very long time, right? And to actually do the right company for the longer term all the way. is actually not easy, because at the end of the day, y- it is, the odds are stacked against you to find the right company. Statistics has shown. And secondly, is that to actually stay invested in those companies, it is also quite hard. S- So if this is the case, then going into a passive investing through a global ETF would be actually a better option to get started with. And why is that a global ETF? Because if you can see here, global ETF, those companies mostly that are listed in the US, in the developed markets, they actually, if you can see, how do you read this table, this bar chart, is that derive most of their revenue out of their home country. Okay, so to put this in perspective, it's right. Um, let's take like example, I've been giving the local example here, Maybank, right? So Maybank's majority where the clients are. I mean, they do have regional presence in ASEAN, but majority of the clients are actually just Malaysians, right? But that is not the case for US companies. Today, every single one of you are using some sort of products from the US, right? It doesn't matter that if you use Huawei phone, or Xiaomi phone, or Oppo, or any of those China-made phone, the software could be also their own OS, but the apps that you use, don't tell me that you don't use WhatsApp at all. Okay, so, or the work that you do, or even today, right? How you're streaming like today's session, Zoom or YouTube or on Facebook, are all American listed companies, right? So we are actually indirectly, directly clients contributing to the revenue of these companies that's listed in the US. And because that they are such big MNCs, they do not actually depend on the economic situation of just one country to actually to get their revenue, and they are truly global companies. So you can see here that how so that uh, where almost half of the revenue is actually derived out of their home country. And also when we look at size itself, right? This is the market cap of Maybank. This is DBS, the largest bank in Singapore, ICBC, the largest bank in China, and JP Morgan, the largest bank in the US. So when you have the option to actually get exposure to the largest bank in the US and probably and also the world, then what is stopping you then? If you can actually have exposure to that. And also the beauty of actually investing in a passive global index is by nature they are natural selection of survival of the fittest. So what do I mean by this is that if you look at this is actually from the S&P 500. Remember, S&P 500 are the 500 top companies that's listed in the US. In the 80s, in the 90s, in the 2000s, and then currently, right? What do you see here? It's that the companies that is listed, the top companies in the 80s are very much different from in the 90s, the 2000s, and the early 2000s. And if you notice, right, the companies, there's only one company from here that is still survived until today. Guess what? Okay. So if you have not catch it yet, it's actually, yeah, Microsoft over here, right? So you see Microsoft here, that's Microsoft here, that's Microsoft and Microsoft, right? And you see none of these companies, right? The one that's in green, the one that's in gray actually managed to come to survive until here. Okay, so the thing is that if let's say just example, right? You were here in the 80s and actually you bought Kodak or ExxonMobil. I mean, today it is done, but if you have actually held this company until today, right? I mean, it is maybe today because of the oil price, yeah, it would have been good. Maybe not with other companies like General Motors or AT&T or IBM, because now it's all driven by this so-called Max 7. By when you buy into ETF that actually tracks the top companies in the world, what you are doing is that at any single point of time, you are actually always holding the best companies without guessing, right? Because the nature of the index, the nature of how that index actually tracks and the way that the market moves at any single point of time, you are always holding the best companies in the world. So today it could be Microsoft, today it could be Amazon, today it could be Google, tomorrow maybe there's another new company that comes in, we don't know. But and I don't care because at every single point of time, I always know I'm always holding the best companies in the world when I actually buy into an index that tracks the world index. Okay, so that actually brings us to that. That's um, there's no market timing, there's no stock picking, there's no following the news, like I said just now, right? And you might think that, well, this is just too boring. But oftentimes, boring is what makes money. The more you actually tinkle and disturb your investments and compounding, then the higher the probability of chance that you might actually lose money. And to get into this, right, to get into more detail, to go deep dive into what you actually would be owning if you actually invest into the VWRA ETF. It's that basically you, as I've actually shown you earlier, you're owning these companies and more. And what actually the ETF does is that it tracks the FTSE All World Index. And what's interesting about this particular index, the world index, is that it's not only limited to developed markets, the Western market. You also have exposure to the Asia market. So remember earlier, I showed you that it also has Samsung, it also has Tencent. So here you can see that Tencent, that's TSMC over here. Um, and Samsung over here, but it's predominantly US based because that is how the global market is, right? 70% it's of the global markets, it's in the US market, but you're not only focused on one market in particular, but you're actually getting the best of the stocks globally, right? And this has been actually the average return. And again, these numbers are for the 3 years and 5 years, these are annualized return. So just imagine, right? This is basically doing a bare minimum just by tracking the global indices, the global index, and with that itself, right? And constantly like investing into it, you're just getting around 10% returns, right? So is that a good deal? I will say yes, because there's basically no effort on your side, and still you're getting it. Okay, and you might think that I might make it sound so easy. You'll be like, hey, Bhushan, it's like so easy, man. Like you just do this and then you get the return. Oftentimes, actually, it is not, because there is something that where we can actually self-sabotage ourselves. And that is where we need to implement one more powerful tool into our investment, and that is called the ETF regular savings plan. To show you an example, right? So this is actually Peter Lynch. He's actually one of the best fund managers in our time. He managed the Fidelity Magellan Fund during the 80s and 90s. And during this time, right, the fund that he managed returned actually 22.5% per year compared to the 16% from the S&P 500. So means that if someone who just invested in the S&P 500, they get 16%. Someone who invested in his fund, who he does the analysis and he does the stock picking, would have gotten 22%. Good deal, right? But when he actually looked at the average investors in his fund, they only made 7%. Surprising. And this is actually underperforming the S&P 500 itself. So how is that possible? Like your fund actually did like 22%, but your average investors who are invested in the fund actually made only 7%. Okay, because what he found out is that investors actually apply in money. That means they actually invest into his fund when the market is good. So they always end up coming in at the high, and when the market drops, they actually panic and then withdraw out of the fund. So our conventional wisdom is, what we know, it's that buy low, sell high. But what everybody does is that buy high, sell low, and that is because we are very much human. We are very much driven by psychology, and psychology works against us when we actually do against what is conventional wisdom. Okay, and what is the cost of this then? uh, then if you can say that, okay, you know what, I will wait to get invested. I will actually wait, maybe the market is too elevated now, prices have run quite high, I'll just wait. And what happens is that this is actually an internal data that we actually created ourselves. Kevin, one of our research senior research analysts, did this, and it shows that if you actually just stay invested, doesn't matter where the market moves, right? This is the returns that potentially would have gotten. But if you actually just miss the 10 best days, that is the returns that you would have gotten, and so on and so forth. If you miss the 60 best days, this is the return you get. But what's interesting is that if you just turn back and look at history, right? Oftentimes, the best day in the market is always it's followed by the worst day in the market. If you don't believe me, you just go back and see like the bottom of the March, Iran, when the market was down during the Iran war, right? The best day was actually when the ceasefire was announced and the opening of the Straits of Hormuz. It proceeded after that. If you just go back 1 year ago during the tariff war, the so-called Liberation Day, market just tanked, and the best day is the next day itself. So in hindsight, when we look at all this, it looks like wow, I should have just invested then. But when we are at that point of time, remember, just imagine, today the market maybe tanked. It's already like it went down 10%. It went down another 5%. Would you have that so-called that guts to actually invest more during that point of time, right? Textbook says that is the best thing to do, but in during that, in realistically, that is very very hard to do actually to do and take action. That right, we self sabotage ourselves, and that is why it is best that we actually stay invested by using an RSP. RSP means a regular savings plan, because that it is automated. You just don't care what happens in the market. You just keep investing consistently, and you accumulate, and you actually reduce that friction. And then you might actually ask is that what if actually I'm really scared? What if actually the market drops today? So I'm not using a world index, but I'm using the S&P 500 because in the world index 70% it's actually the US market. So if you see, right, on average, the market has always been on a positive note compared to on the downside. So how do you look at this? Is that the bar charts? These are how the year ended for every single year. The red dots are one of the worst performing days in the market. So you can see that over here the market went down 19%, but the year ended 27%. Right, the market went down 10%, but the year ended positive 24%. Of course, there were times that the market was down all the way 50% and did 38%, but you see that subsequently it actually recovered, right? So you see more positives than negatives. And if you try to time this, then all the best to you. And what's more better will be just to RSP to capture across all the market movement. So where your investment is actually before this, you actually if you don't not, if you don't actually set up an RSP, you what you're missing out is automating your investment flows. You might actually miss out, you might actually forget, then the market news will actually impact your emotions to invest. But when you actually just set up the RSP and automate it right, everything just runs like a machine, right? So you just set up your bank account, you do a sending instruction to the cash account, either to a cash account to the auto sweep, and then you set up your ETF execution, and then it just runs. And every single month you're invested into the ETF portfolio. And what you'll know is that, and this is actually, if you're familiar, this is Warren Buffett, uh, one of also the greatest investors. The highlight here is that not to just invest, but to be consistently invested in the right instrument in the market. Okay, and and I'm almost at the end of my presentation, and then I'll just leave up for Q&A after this. Uh, is is to show us that some of the caveats here, right? I've been highlighting is that to actually invest consistently into the global markets. And why also in the global markets is that because not every markets are the same. So if you actually can't do this, for example, in the Malaysian market or maybe in the China market, those for those markets, there are different ways to approach those that particular markets. But you can do this in the global markets because it is an aggregate of the best companies globally, and it's not restricted to just one particular geographical sector. Okay, so if this past 45 minutes of me building my thesis to you is, if you're convinced with it, if you're ready to get started, this is how you can get started. If you have not, if you already get started, I hope that this actually builds into your confidence that what you're doing is correct. And why with FSM? Because we not only have US listed ETF, we also have LSE listed, and we have a lot of broad-based index. And the best part is that this comes with zero fees, right? There's a zero processing fee, and you can actually start from 100 ringgit today. Okay. And at the same time, besides having zero fees on the ETF RSP, if you want to actually buy the ETFs directly from the market, then we also, if you have seen from this Monday, we have actually introduced a flat fee of $3.80 for ETFs that's listed to buy ETFs that's listed on the US market, on Hong Kong, and also sorry, on these two markets, and for one Bursa will be from 3 ringgit and 80 cents. And why? This is a good option for you to get started. It's that because of the zero fee, you keep more of your returns. As I mentioned, global access, especially the London-based, London-listed ETFs, that gives you the accumulating class, and more importantly, right, very often we do webinars like this, that we guide all our investors to actually invest, to get invested, because our goal is actually to help our clients to grow their wealth globally and also profitability. We don't encourage frequent trading, we encourage wealth accumulation. And these are some of the examples of the top volume RSP. You can see that VWRA that I mentioned earlier, it's the top investors that have been accumulating. So you're not alone. And also, these are some of the feedback that we have gotten across on the social media, on Reddits and whatnot, on why do they actually prefer the FSMOne platform to get started. And again, to conclude, right, zero processing fee, can start from 100 ringgit, fractional shares. And what's more important is that you, what's more important is that it uh, reduces the friction of manually investing, because what is automated gets done. So, okay, when 3 minutes ahead, that concludes my sharing. So let's have some discussion. Let me just look at the Q&A and see. Scared to invest. What's the difference between W mentioned compared to VWRL? Okay. What? But the management fee W is 0.01, Vero is 0.2, so dividend investment will perform better than Vero. Okay. This is actually a very common questions that we get, right? Why? Okay, the trade-off between the fees that you pay, LSE usually they have like higher fees, but in the recent times we have seen that a lot of those listed on the LSE, they have actually been reducing their fees. Um, but if you there's actually a formula uh, to actually calculate what is the impact of the dividends, the withholding tax compared to the fees that you're paying. And then when you compare this, right, then end up we see that the the net impact of the tax outweighs the fees that you're paying for the VWRA, even though that VOO is 0.0, it has a lower fee. And remember that, so the strategy and the role is different here. If your objective is actually to buy and sell, then go for the US listed one. If you're looking at a short-term trade and you're looking at valuations, and you know how to do this, and you want to buy into the market, then I will say that the the US listed ETF will be a better option. But if your strategy is to actually in the next 5, 10, 15 years is just to accumulate, then go for the London listed one with the ETF RSP. So first thing is that define what's your objective, then you would know how to use all these two different tools to do it. Is there Sharia compliant, if not any similar ETFs? Yes, there are Sharia compliant ETF that's also listed on the London Stock Exchange. What you can do is that you can, after this session, drop an email. Let me Yeah, drop an email to actually our investhelp.my@advancedsupermart, and we can actually share with you. Out of my head, that I know that's listed in the US market, it's like SPUS, H Halal, UMMA. These are some of the examples of Sharia compliant ETFs that's listed on the US market. There are also on the London Stock Exchange. Just drop us an email, and we are more than happy to actually send you that. How's the return like for the past 10 years for global ETF? Yes, returns actually I've shown you earlier. Um, the past 10 years on average, it's like 10%. Um, but that is, of course, again, past return. I mean, past performance is not an indication of future returns. But what I would like you to look at this is this way, right? Um, in the long run, okay, this might sound something blasphemy, right? I'll say that the global markets in the long run always goes up. I wouldn't say this for any other markets except for the global markets. It's why do I say that? It's because I'll say that the global market is always on a bull run. In the short term, there will be some bear markets, but if you stretch it out in the long run, why? Due to the human ingenuity of human and the always it's just the nature of human being that we want to do better and better in life, right? If you just look at something very simple example, right? For thousands of years, when wheel roda chakra was wheel was invented, right? Then there was the horse cart. Sorry, bullock cart. Then there was the horse cart, right? And then after that, there was the first car with Ford and Benz, right? And then after that, there is the now the EV car, right? So it's the same thing, same round thing, the wheel. But you see that how we have evolved from what we had thousands, hundreds of years ago until now. So that is what is moving. That is the nature of human being to actually to improve ourselves, improve what we do, im- create more efficient and productive thing. And this indirectly reflects in the companies that are actually championing this. Can you tell us how to invest in VWR? Yeah, I just showed you. If you can actually just go create a ETF RSP contract. I think this is a very good example. This is personally something that I'm doing. It's that when you get your salary, you have your that comes to your bank account. Set up a standing instruction to the cash account or the USD auto sweep. Okay, you can actually also fund with the USD auto sweep because remember at the end of the day the underlying are in USD. So um, and then you can actually do the choose pick the dates, any four of the dates to do monthly. Please free to post your questions, Q&A institute when there'll be best address. When's the ideal length of the ETF cycle? What is the ideal length? Okay, ideal length, I'll say the one market cycle, the short and long, 3 years, 5 years, right? So this, when you're doing this, right? Okay, when I say that the one investment that everyone should have, I literally mean that means you should have this, your friends should have this, your parents, your siblings, your colleagues, everybody should have this. But what it doesn't mean is that this is the only thing that you should have. But it is the one thing that you must have to build a base upon the most basic standard. After that, after you get, if you're not confident in the market, after that, when you get more confidence in the market, then you can actually add in more tactical plays, right? More tactical bets. And when you can do that, but this should be your very bare minimum core that you have to actually build upon. RSP using FSMOne is cheaper than other platforms. Actually, yeah. It's not what I say. It's what others have. That's what others have been saying. Because they have done uh, they've like looked at it. Yeah. What is Savage University White? It's actually no charges. There's zero processing fee. What is FSMOne charging in investing ETF via RSP? There's no charges. It's zero fees. The only charge that you'll see will be the stamp duty that goes to Bursa. Is there a particular day the RSP buying the ETF? Um, Okay, is that a particular day of the RSP buying ETF? Yeah, there are actually four options, right? First, 8, 15, and 22nd. So you can pick any of those days. If you want to sell my ETF, is it auto buying or must have buyer? If you want to sell your ETF, because if you are starting with 100 ringgit, right? So basically you're owning fractional shares. Means is that it's just very small amount. I mean less than one unit. So when you want to sell, you can only schedule sell on the 15th of every month. But once you have accumulated and your unit becomes one unit, one full unit, then you can actually sell anytime when the market is open. If I want to sell my ETF, is it auto buying? Okay. I plan to hold for 30 years. Wow. S&P 500 index. So VW will be my plan. I will switch from VO to VO. Okay. So hold your horses, hold your horses. 30 years S&P 500 index. So if you're already doing S&P 500 index, right? VOO, that is okay. The equivalent for S&P 500, like I showed earlier, it's VUAA. VWRA, it's actually it's broader. Predominantly, it's US markets, but you also have exposure to other markets, emerging markets, like you saw just now, Taiwan, China, Korea, and whatnot. Because what we see is that now, especially currently, like if you see like the semicon, the players, right? They are not only your American US based players, they're also your Samsung Hynix, your TSMC, your Japanese players. So the entire uh, AI revolution is driven by global company that's listed globally and not only just listed in the US. So to capture all this, then a good starting base is where VWRA comes in. Okay. So those are the questions. I'm actually seeing, wait, there's a Q&A. Sorry. Wow. Uh Okay. The well data you showed is from US. How well do we correlate the Malaysian situation? Malaysia probably are better in savings than US. Actually, you are very true. There is data. The question here is that the well data you showed from the US. How well do we correlate to the Malaysian situation? Malaysians probably are better in savings than in the US. That is true. Our a lot of money of Malaysians' money are actually in the deposits. But then again, right? If you ask me, um, if it is just staying in deposits and then just by staying there, inflation is actually eating that up, right? So in last time, like during the parents grandparents time, that would have probably worked, right? But now with inflation, if what is the general earnings of Malaysians is it is not enough to cover, so that strategy then would not work in this current situation. How about those ETF that is actively managed, like Category Disruptive Energy? It is extremely high risk. It is correlated more than 60%. It's okay. That's the thing. Uh, Today's strategy is passive strategy, right? It means is that you just buy and hold and just track the market. The disruptive innovation arc, those are actually active strategies. They're still ETFs, and these are very tactical bets that you need to have an entry and exit strategies. So you cannot just invest into it and just hold through it along the way. Um, and and um, and that is why if it's better that if you want to just get started, just go with VWRA. The difference between these two will be the currency. This question on what's the difference between the two different ticker symbol, because any ETF that's listed on the London Stock Exchange comes in also GBP and also in USD. It'll be better that for you to go for the USD one because your underlying assets are predominantly in dollar. Accumulating ETF, at what price point is the reinvestment done? Uh, at that's the okay. That is, it's not disclosed. Whenever that there is the distribution that is announced, I mean actually because the nature of the ETF itself is accumulating, so you don't have an income distribution that's being dividend distribution that's being declared. Would the compounding of EQQ SPY better than VWRA or SPY? Okay, EQQ, it's a different index. S&P is actually a different index. VWRA is a different index. So all these are actually valid indexes to have. If you look at the underlying S&P 500, the QQQ, Nasdaq, and VWRA, if you look at the top companies, they would actually overlap. They are kind of similar one. You'll see the usual Max 7 suspect, confirm. Okay, so they serve a different purpose. VWRA is, if for you, this should be, as I said, it's a base that for you to get started. And you are actually not only having US companies, but global companies, right? After that, you can actually add in tactical with just pure tech plays, with pure semicon plays. So these are all your tactical bets to actually add on after you actually build your solid base. The pros and cons. Okay, again, VU, can you compare VUAA and VWRA? Okay, so let me just bring everybody back here again. Uh, we are what are the pros and cons? Okay, uh, let's again bring when we have a lot of options, right? We tend to actually do this comparison. But what's more important is to see what is our investment objective. Okay, so VWRA again, as I said, serves as a base. Why not S&P 500? Actually, right, from the returns perspective, if you see in the past years, you actually would have done better investing in that just with the US market in S&P 500 compared to the world market. That is very true. Data actually shows that, right? You can't deny that. But the point here is that not every single year that the US performs well. Then again, VWRA predominantly is the US. But but you are actually, since you're having exposure not only in the US markets, but also other markets in the emerging markets, then your volatility will be lesser. You will impact of it will be the right of your investment will be smoother. And that is why again I say have this as a base. ETF in LSE will be invested in USD GBP. Okay, I've answered this earlier. They are both options are available. But if you're going, I will actually suggest to go for the one that's in USD because your underlying companies are actually in USD mostly, and you wouldn't want that ringgit, GBP, USD, so many conversions that's happening. Okay, is investing just in VWRA enough? Very good question. Okay, I love this question. I would say no, but investing in VWA should be a must starting point, at least, right? It is definitely not enough, but it is something as a base that everyone should have, right? That you build onto more, more, more sectors and regions. How do we assign the fair price value of underlying stocks of an ETF? Should we consider the fair price to reset entry? No, not at all. Because remember the thesis here is that you're not actually you're not looking at the markets. You're just not doing anything. You're not determining the valuation, the fair price. None of it does actually matters, right? Because you are just consistently buying into the markets. Because, for example, when we started the year, the narrative was that the market is overvalued, which is very much true. But then along the way, what happened was that the US-Iran war, right? The US-Iran war, and then we had a pullback in March. So, how many actually bought the so-called dip in March? How many would have actually had the guts to buy the so-called dips? Because everybody was talking about World War III and the end of the world, end of the world. But the markets subsequently recovered a very strong recovery and reclaimed back the all-time high, right? So, and again, I've shown you that the best days usually comes after the worst days. So instead of looking at this, you want to do that, you can do that. I mean, there are many ways to do that. But what my thesis here is that just RSP into it, you don't care about it, and you just let the market do what it wants to do. But what's more important is that you're constantly being invested in the market. Okay. Since no professional team monitoring on individual company stock of the fund, only monitoring the index, will be weighted for investment company. Yes, correct. Sorry, I actually overrun a bit already. And I hope that it is okay. A lot of questions that's coming in. Let me just quickly answer all the questions, right? Yes, there's no professional team monitoring the individual companies. It is just based on what's on the index. So that means there will be a certain point of time that certain companies have more weightage compared to some other companies. And of course, there are some ETFs that you can actually get. They're capping in the weightage. There are a lot of ETFs that can do that. But my counter argument thesis into that is that if that company is the best company and if they're actually holding a larger market share because of they are the best, why not? Right? If Nvidia or all the Max 7 has like almost 30% or now 40% of the S&P 500, why not? because they actually can command that, and their earnings is actually supporting that. So why not? Okay. Uh, so for a truly global ETF, is Vanguard FTSE All Regular one you suggest, or are there any tax arguments against it? Okay, yes. Truly global ETF to get started. This is one ETF that you can actually get started. Which ETF reported for long term as per the VWRA? Long term, can you just consider that VWRA? Uh, okay, what about using Vanguard, iShares, SPDR? So these are all different issuers. Safer, all of them are global players. Their asset under management it's in trillions. So all of them are actually pretty much safe. Vanguard was the pioneer. They started index fund, and the rest, BlackRock and State Street actually followed after that. So you're actually, it doesn't matter. Any of this, it's a good pick. Just look at as long as they actually track the index correctly. Not all, correct. If you actually, how does one ETF change their holdings, and how do investors know when the ETF? Okay, you can actually just go to the FSMOne website and look at that particular ETFs, right? You can see under the holdings, and you can see the weightage of the top 25 companies are listed on that, and every single day this number actually changes. Uh, I've already buying into ETF Vanguard. What's your opinion? Using it? Is it continuing? How many years should I keep? How many years should I keep investing? That is a very personal question that I would not be able to answer. Um, but like I said, that maybe what you can think about it, right? The way you can think about this is like this is your second KWSP. This is your second engine, your second EPF, right? So you already have your EPF on one side. This is your second engine that you're opening to turbocharge your retirement pot. How sure we are not subject to US income tax we invest in? Yes, we are not actually. There are many contradicting views there are, but I'm not licensed as a tax advisor, so I would not be able to final say that. But based on our understanding of the structure of the LSC listed companies, it is not. The best to answer this on the tax itself in detail would be fine to find a tax consultant. Do we need to monitor and keep track of the ETF performance? Is it ourselves? Yes, you can do that. You can actually look at the market, time the market, but I've actually shown you data to prove that um, staying invested and just RSP would be actually do a better way for you. I'm 70 now. Can I invest in the VWRF ETFs? Yes, Gurmail, you can do that. Why not? Which is better to start RSP to beginner? Yes, for beginner, my thesis here is that just start as VWRA. ETF in LSC will be invest in USD or GBP. I've answered this. For accumulating ETF, is there a way we can see how much dividends declared and reflected in our holdings? No, actually. But what there is a way you can actually drop in, and it's not a direct answer. You can actually drop in an email. We will be able to answer that. Does capital gain subject to tax in UK of selling ETFs in LSC? In the UK, tax questions I would not be able to answer. I'm sorry. Um, how often does one ETF change their holdings? How do you investors know when the ETF makes such changes? When the holdings or when the index is being updated, depends on the index when it's being updated. Each index have their own methodology to update the index. But the holdings you can actually see the changes in the holdings every single day because it is on what is the market cap of those particular stock that is listed. Okay. So, wow, that is a lot of questions, and I'm sorry that I actually extended like 10 minutes. And thank you so much for all those questions. I hope that I managed to answer all the questions that you had today. But in the case that I was not able to answer, I would have been gone too fast or would have missed some of the questions. You please feel free to actually drop us, and let me just go back to my very last slide. Uh, Email at investhub.my@fundsupermart.com, and we'll be more than happy to actually answer your questions. And let me just quickly also check the chat box. Yeah, I think that's all done. And my colleague Harriet has actually also given the email. Right. So with that, thank you so much for staying back until today, until this late. And I hope that it has benefited everyone. I hope that Yeah, I did not disappoint you. I was just worried that maybe the title would have, you might have come in expecting something and it might not, you might have seen that, oh, it's just ETF VWRA. But what I hope it's to present to you is that just by doing something that is very simple, it's actually good enough to get you started, and you would actually end up better than most of the investors out there by doing this consistently over the next years to come. All right. So with that, thank you so much, and I hope you have a good day and the rest of the week, and catch you soon. Thank you, and take care and good night, everybody.